So as a realtor or real estate agent, your goal and what you love to do is represent your clients to either one, find them the home of their dreams, or two, help them sell a property at a price that is appealing to them. So how do you get paid for doing something that you absolutely love to do? So let's talk about it. But before we get started, if you want to learn how the wealthy use the tax code in order to save on taxes and build wealth within their business and their investments, make sure you like this video and you are subscribed. So let's talk about how you pay yourself as a realtor. Let's start with talking about how you operate your business as a realtor. So as a realtor, that means that you do not work for an employer or anyone else that pays you a ongoing salary on a periodic basis. They don't withhold taxes and submit them to the IRS, and you do not receive a W-2 form at the end of the year. You are considered to be what's called an independent contractor, meaning that the work that you do as a realtor, you receive commissions from your broker and they pay you based on what those commissions are, and you receive a 1099 form for what that amount is. And so you are responsible for reporting your income to the IRS and paying any taxes that are due to the IRS. Well, how do you get paid? So most real estate agents operate through one of three business and entity structures. So depending on your entity structure, it's going to depend on the best way for you to pay yourself. And so one, if you are what's called a sole proprietor. So as a sole proprietor, that means that all of your realtor business and operations are done within you as an individual, as a person, through your social security number. You have no legal setup and it is you. You are your business. And so as a sole proprietor, you pay yourself through what is called owner's draw. And when you do an owner's draw, that is when you take money from your company and use it for personal use. It is a way for you to access your funds based on your needs, based on bills that needs to be paid, based on whatever it is you have to pay for personally, separate from your business expenses. And the way that you do an owner's draw is that you will either write a check or you will transfer funds electronically from your business account to your personal account. Now, if you have other employees that you do employ or those that work for you that you pay as W-2 employees, then your paperwork provider may submit and provide you with paperwork according to your owner draws. It's important to remember that if you receive an owner's draw, that is not a taxable event. You will pay tax on the profits that you have at the end of the year from your real estate operations. So that takes into account any owner's draws you have, as well as any business expenses that you may have. So the second way that many realtors operate is through an LLC. And so operating through an LLC means that you have established a legal entity structure with the state that you are working in as a realtor, and you've also obtained an EIN number through the IRS. And so all of your business operations are done through your LLC. And so as an LLC, you pay yourself very similar to the way a sole proprietor pays themselves. You will also take what's called an owner's draw, and that is when you take money from your company and use it for your personal use outside of your business expenses. Again, you will either write a check or you will transfer funds electronically from your business account to your personal account. And again, this is not a taxable event if you operate your real estate business as an LLC, because your owner's draws are taken into account with all of the business expenses that you pay the profits on at the end of the year. The third way that many real estate agents and realtors operate is through what's called a S corporation. And if you operate as an S corporation, then you are completely separate than your business. Your business is considered to be one entity. and you are considered to be an employee of that business. And so you are working under your S corporation. And so because you are an employee and you also own your business and you are doing work within the business, the IRS requires you to take a salary. And so as you take this salary, the IRS requires your salary amount to be something called reasonable compensation. Reasonable compensation is the salary amount that you as an employee of your business gets paid in order to perform particular services. To be considered reasonable, the IRS requires the amount that you're paid to be equivalent to what a similar business would pay someone in your capacity. The salary that you do receive as an employee is received through a W-2. So that means that periodically you are paid from your business through a W-2 paycheck. So you can determine whether you want to be paid every 2 weeks, every month. It is up to you what those increments are going to be. But if you are generating a profit throughout the year, the IRS does require by the end of the year that you've paid yourself reasonable compensation. Now, if you are operating as an S corporation and you do need to pay yourself, it is always a good idea to utilize a payroll provider service because that service is going to ensure that you are paying the proper amount of employer taxes as well as the employee taxes from the amounts of W-2 income that's received as an employee, as well as any state type of payroll taxes that needs to be remitted as well too. I would not suggest you taking a chance of trying to do that yourself. You may be completely capable of it, but using a payroll provider is very easy. It's cost efficient. It's worth the price because it ensures that you are following all the guidelines when it comes to any type of payments that does have to be submitted to the IRS. Now, once you pay yourself reasonable compensation, do your W-2, then you can take what's called distributions out of your business as an S corporation. And that function is very similar to taking an owner's draw because also this is not a taxable event. So a distribution is an amount that an owner takes from the business once they have received their reasonable compensation from the business. It's important to understand that you must take reasonable compensation before you take distributions. And again, distributions are not considered to be a taxable event. You as an employee are taxed on the W-2 income that you do receive, but you receive those distributions as a non-taxable event. So that is what you need to know as paying yourself as a real estate agent. If there are any topics that you want to know more about or you're interested in, want to see a video on, leave it below so we can discuss. And also use the link in the description below in order to download your guide to the 12 biggest tax deductions for real estate professionals. Again, make sure you like this video and you are subscribed.